Investors want to take cash out of their properties. In many cases, they want to use a DSCR loan. And as a loan officer that helps people with these type of loans, sometimes to buy, sometimes to refinance properties, I see these estimates they get from other companies, and it's so deceptive, doesn't accurately reflect what's actually going on. So there's three things when it comes to a DSCR loan that affects the interest rate. One is the loan to value. Two is the DSCR ratio. That's the rent compared to the mortgage payment. And three is the pre-penalty payment. So when I see these estimates, in many cases, what I see is they put a value on the property that's inflated. So if the property was worth, I don't know, $300,000, when they do these estimates, they say the property is worth $350,000. And what they do is they do a lower loan to value. So the ideal situation is 60%. What I mean by that is if the property was worth $100,000 and the loan was less than $60,000, that would be 60%. As the LTV goes up, 60 to 65 to 70 to 75, the rate goes up too. So almost all these estimates that I see go out have these inflated values, and they use the 60% loan to value, which in many cases is not the amount of cash that the person needs. The second thing they do is the rent that the house or the unit brings in. Let's suppose the rent is, I don't know, $2,500. And let's suppose the new mortgage payment is $2,000. That's a positive ratio. You have $500 profit. The higher the rent, the lower the rate will be. So I see these estimates that go out that use numbers that are maybe 3 times the mortgage payment. So now you have a artificial low loan to value and a rent that's not really reflective of what's actually going on. Then the last thing that these companies do is they do these long-term pre-penalty payments for large amounts. So you can get a pre-penalty payment on a DSCR loan. It could range from 1 year to 5 years. If you take a 5-year pre-penalty payment and you say, I will pay back 5% of the loan balance anytime during that period, let's suppose you borrow, I don't know, $400,000. What you're committing to do is pay the lender back an additional $20,000 if you sell or refinance that property anytime in the 5-year period. I'm not saying you shouldn't do pre-penalty payments, but that is the most punitive one. But when you put the LTV, the pre-penalty payment, and the factor for the rent compared to the mortgage payment in there, and you blow them all up, you get these artificially low rates. People can't really